Thank you for joining our third quarter market outlook. My name is TJ Kistner. I am the Chief Investment Officer at Retirement Plan Advisors. Today I will review market performance as well as go through our forward-looking views across asset classes. We hope you find the discussion helpful and informative.
The third quarter is seasonally the weakest quarter of the year for markets, and this year was no different. U.S. stocks declined 3.25%, outpacing the minus 4.11% return of non-U.S. markets, but trailing the minus 2.93% return of emerging markets. While it's easy to blame technicals for the poor returns, a number of macroeconomic factors weighed on performance. Arguably, the most impactful was the dramatic increase in interest rates, which I'll highlight momentarily. Focusing in on the U.S. equity market, as we look at returns across style and size, the selling during the quarter really was pretty indiscriminate, although larger companies fared better than smaller ones. On a year-to-date basis, we continue to see strong outperformance in large cap growth as investors have favored the safety of the largest, highest quality companies that appear to be most protected against the harmful impact of rising interest rates. Interestingly, the small cap value index turned negative on the year, and the spread in performance between large cap growth and small cap value is now over 25%, which is quite remarkable.
Turning back to the yield curve, I mentioned that this was arguably the most impactful driver of returns across all markets during the quarter. At their September meeting, the FOMC opted to skip a rate hike to assess the impact that prior hikes have had on the economy thus far. Normally, this would be viewed as a dovish sign or a sign that the Fed is nearing the end of their rate hike cycle, but in his post-meeting press conference, Fed Chairman Powell continued to express a commitment to bringing inflation down and promoted the notion that rates will be higher for longer to do so.
The impact on markets was significant, particularly on the back end of the curve, as you can see in this chart. While the entire curve shifted higher, the 30-year portion rose 0.88% and the 10-year 0.78%. These are very large moves for a single quarter, and as a reminder, when interest rates rise, bond prices fall. In fact, the price return on the long Treasury index during the quarter was minus 12.6%. The rise in interest rates has pushed the aggregate index into negative territory on the year, and if it remained there, would mark the first time in history that the index has had 3 consecutive calendar years of negative performance.
Turning our attention to the macro environment, many of the challenges that we cited in our second quarter outlook remain. Inflation remains too high, the labor market is still too tight and should continue to support consumer spending moving forward, and we know the Fed continues to try to slow down the economy. To that end, we are starting to see some data points that would indicate the Fed is making progress, even if those data points are not necessarily favorable. We're seeing a decline in commercial and consumer lending from banks. We're seeing an increase in delinquencies on existing loans. We're seeing higher default rates across corporate credit. Finally, geopolitical risks are back in focus. While this risk always exists, the ongoing conflict in Ukraine, tensions between China and Taiwan, and the most recent news of the events in Israel have heightened concerns about the impact on the global economy and markets.
Switching to our global asset class views, our high-level directional views remain unchanged from the second quarter. We remain neutral to slightly cautious in areas such as equities and credit, given the macroeconomic uncertainties and geopolitical risks I just mentioned. However, not all the news is bad, as the U.S. economy continues to show strength. There is certainly a path for the Fed to succeed in achieving a soft landing if they can slow inflation while maintaining sufficient economic growth so as not to dramatically increase the number of unemployed workers. Last quarter, we discussed the attractive total return profile potential of treasuries, considering rates were above 4% at that time. Now, with rates closer to 5%, that potential is even greater, although some short-term price depreciation is possible if interest rates continue higher. Historically speaking, it's very rare for the Fed to be able to cut interest rates in an orderly manner in the same way they increase them. Typically, what you see is they are forced to cut rates to respond to some sort of exogenous shock or a material decline in economic activity. While those events are impossible to predict, they can unfold very quickly, and the response in interest rates can be dramatic. We think treasuries and even cash can provide a hedge against such events, especially in the current interest rate environment. Now, drilling one step further into the equity and fixed income markets, once again, our views here have not changed from the second quarter, and we remain neutral across the equity spectrum with a preference for quality companies and businesses, particularly in the U.S. While we've seen some bright spots outside the U.S., specifically India and Japan, there continue to be significant headwinds around the globe. With respect to emerging markets, continued weakness in China's economy and a strong dollar could prove problematic for those areas of the world. Within fixed income, once again, our views remain the same, and we continue to have a preference for higher quality credits and are wary of areas of the market that are below investment grade, such as high yield bonds and bank loans. Although credit generally looks pretty healthy at the moment, rising interest rates are starting to have an impact on certain companies' ability to service their debt, and the spreads offered above treasuries in these markets are relatively tight and don't properly reflect the risks embedded in those securities.
Thank you for listening. We hope you found the information helpful, and remember, the future is better than you think.